This past week, Supermicro Computer delivered a record-breaking quarter, with revenues that didn't just beat expectations, they shattered them. The company raised its full-year sales forecast to an impressive $40 billion, signaling that the AI infrastructure boom is in full swing. Yet, at the same time, profit margins fell to their lowest levels in years, causing a sharp divide on Wall Street and leaving the stock on a roller coaster. Is Supermicro's staggering growth a sign of market dominance or a warning of a profitless boom? Welcome to TickerWatch News for Supermicro Computer, Week 7, 2026. This is the weekly report covering the news and developments for Supermicro Computer, a company at the very center of the artificial intelligence buildout. This week, it's all about the push and pull between explosive growth and mounting financial pressures. Stock snapshot. Following a huge post-earnings rally in the prior week, shares of Supermicro Computer experienced significant volatility. After surging on the initial news, the stock saw a pullback, trading in a range around the low 30s for much of the week, with prices around $30.45 noted late Friday. This price action occurred amid a mixed environment for the broader market. Technology stocks saw a sell-off early in the week over concerns about AI spending and valuations, though some buyers re-entered the market looking for value in oversold names. Supermicro's journey reflects this broader uncertainty, as investors struggle to balance the company's incredible sales momentum against its profitability challenges. Top news and headlines. The dominant story for Supermicro remains its fiscal second quarter earnings report, released on February 3rd. The results painted a picture of a company firing on all cylinders, but also facing significant headwinds. First, the headline numbers were massive. The company reported revenues of $12.7 billion, a 123% increase from the year before, and more than $2 billion above what analysts had expected. This growth was driven by what management described as unprecedentedly strong demand for its AI-optimized servers, with one large data center customer accounting for roughly 63% of the quarter's revenue. Buoyed by this demand, Supermicro raised its revenue guidance for the full fiscal year 2026 to at least $40 billion, up from a previous target of $36 billion. The CEO even called this new higher target a conservative estimate. However, the second major story was the significant pressure on profitability. Gross margins fell to just 6.6%, a steep drop from nearly 12% in the same quarter last year. Management attributed this compression to several factors: a product mix tilted towards large, powerful customers with significant pricing leverage, higher freight and logistics costs to meet demand, and ongoing component shortages. This margin squeeze has become the central concern for many analysts. The competitive environment is another key headline. Reports this week reiterated that Supermicro faces intense competition in the AI server market, with established players like Dell Technologies and Hewlett-Packard Enterprise. This rivalry is keeping prices tight and makes it harder for the company to protect its profit margins, even as sales volumes climb. In response to these margin challenges, the company is focusing on its Data Center Building Block Solutions, or DCBBS. This initiative offers customers more complete, pre-configured systems that include servers, storage, cooling, and software. Management believes this more integrated approach will deliver higher margins, over 20% according to the CEO, and expects it to become a more significant contributor to profits by the end of the year. Finally, Supermicro announced it will be participating in several investor conferences in March, including events hosted by Morgan Stanley, KeyBank, and Loop Market Markets. This signals that management is actively engaging with the investment community to address the questions surrounding its growth and profitability. Market reaction and investor sentiment. Wall Street is deeply divided on Supermicro. Following the earnings report, analyst price targets have been all over the map, reflecting the conflicting narratives of revenue growth versus margin pressure. On one hand, some analysts remain bullish. Rosenblatt reiterated a buy rating with a $50 target. On the other hand, Goldman Sachs maintained its sell rating with a $27 target, citing the margin concerns. Other firms landed somewhere in the middle. Barclays and Needham both lowered their price targets to $38 and $40 respectively, while Mizuho raised its target slightly to $33. The consensus rating among analysts is currently a moderate buy, with an average price target in the mid-40s. The narrative from analysts who are cautious focuses on the high customer concentration and the lack of visibility into when margins might improve. In contrast, bullish commentary points to the sheer scale of AI infrastructure demand and Supermicro's ability to deliver customized, high-performance systems to market quickly. Retail investor sentiment appears to be highly speculative. One report noted a social media post from a trader who claimed a 20% gain in 20 minutes using a leveraged ETF that tracks Supermicro, indicating strong interest from traders looking to capitalize on the stock's volatility. Technical and fundamental check-in. From a technical perspective, the stock is in a battleground state. It has a significant amount of short interest, with about 17 to 18% of its available shares being bet against. This setup creates the potential for a short squeeze if the stock breaks through key resistance levels. One such level that traders are watching is around $35 per share. A sustained move above that could trigger further buying. On the fundamentals, the story is a classic growth versus value debate. The company's revenue is expanding at an exceptional rate, with a 74% annual growth rate over the last 2 years. Based on its forward price-to-earnings ratio, which sits in the mid-teens, the stock appears undervalued compared to the broader tech sector and other AI-focused companies. However, the risks are clear. The company's debt-to-equity ratio of nearly 67% is considerably higher than some of its peers, signaling greater financial risk. The core of the investment thesis remains the tension between its explosive top-line growth and the persistently low and pressured profit margins. The question is whether the company can convert its massive sales into sustainable profits over the long term. What to watch next week? Looking ahead, investors will be closely watching for any updates on the key themes from this week. The upcoming investor conferences in early March will be a major catalyst. Management's commentary at these events will be scrutinized for any new details on margin trends, customer diversification, and the adoption of its higher-margin data center building block solutions. Any news related to the broader AI hardware supply chain will also be critical, as component shortages were cited as a factor impacting margins. For the stock itself, the $35 level remains a key price point to monitor. In terms of scenarios, the bull case is that Supermicro shows progress in improving its margins, diversifies its customer base, and continues to ride the powerful wave of AI infrastructure demand, potentially exceeding its already strong guidance. The bear case is that margin pressure continues or worsens due to intense competition, and that any slowdown in orders from its single largest customer exposes the risk of its revenue concentration. The base case sees the company continuing to post strong revenue, but with profitability concerns capping the stock's upside, leading to continued volatility as the market weighs these opposing forces. Thank you for tuning in to TickerWatch. This podcast is for educational and informational purposes only and is not intended to be financial advice. It does not constitute a recommendation to buy or sell any stock. Please be sure to subscribe, leave a review, and share this episode.